It's shaping up to be a December doldrums for the Dow. So what about a Santa Claus rally? Well, it may all come down to next week. And, of course, the Fed meeting. Jim Awad is joining us now, once again back here on Arise Exchange to talk about what is happening to the markets right now. Are we looking at just a normal sort of pause and sell-off, or are we seeing something bigger coming
This is all about the credit markets. I've said repeatedly on this program that the economy is fine. The consumer is growing at 3%. You have softness in manufacturing, which is pulling down the total growth rate to 2%, but that's enough. The U.S. economy will keep going if not interrupted, but it looks like it might be interrupted by a deterioration in credit quality in the commodity and energy complex, that those prices have gone down so much, many of them down to where they were during the depths of the 2008-2009 recession. And the companies, many of the companies borrowed heavily, the companies that sell those products, and it looks like you're starting to get some defaults. And if they're small defaults and they're well telegraphed, we can handle it. But the markets are afraid that it's going to spread and you're going to get enough defaults to spook the credit markets, freeze up the credit markets, which would affect the economy and the stock market.
When you're talking about credit markets in the energy sector, are you talking about the shale business here?
Yeah, but way beyond that. It starts
beyond that.
Yeah,
okay.
Because it starts with the shale companies, the small shale companies.
And just to recap, they had to borrow heavily because this was a high capital intensive effort to get to the oil.
Right, but they were growing so rapidly that they were able to borrow the money. And then what happens now is that the prices of energy, but also other commodities, have gone down. So you're seeing mining companies and sellers of all sorts of commodities. And then you have the countries, the emerging market countries that sell those commodities, who borrowed in dollars. And now they're earning in their local currency and the dollar's going up, and they might not be able to repay the debt. So you've got this big change in the world. That China slowed down, it dragged down commodities, energy, and oil worldwide. Now those companies are in danger of defaulting, and the stock market is telling you they're afraid that it's going to affect the economy. And the reason the tech stocks, for instance, on a day like today, have gone down so much is they're the only ones that are up for the year. You know, the Nasdaq is up maybe 5%, but all of it is in 5 or 6 tech stocks. And so if you have some losers and you have to offset them by selling the gainers, so it drags the whole market.
So can central banks do much about a credit crunch like this?
The central banks have done as much as they can. And in fact, the U.S. central bank at this point has to raise by 25 as a vote of affirmation of the confidence in the economy. And it also will give them room to get down 25 if they have to ultimately. So that's the U.S. central bank. The other central banks are doing what they can, but this is about just having the cycle work itself out. You built up too much capacity to serve a growing China that is not growing that much anymore, and you got to take out that capacity.
So this is a classic bubble situation, is it not, in the commodities area and in energy prices, where we saw this huge run up in energy and a huge new industry. It looks like the .com era, if you will, of 2000, this fracking business. I was in New Mexico, and I saw part of New Mexico that had ramped up great, and now people are out of jobs.
Yeah. Now, the other side of that coin is these are very innovative companies, and they are low-cost producers. So when you do get supply and demand back in balance, and if and when prices ever start to go up, a lot of these companies can start producing from their wells again. So there will be light on the other side of the tunnel. But meanwhile, the weak companies with weak balance sheets will go under and will pay the price. And the question is, can the American consumer, growing at 3%, power their way through?
And so lower oil prices do help the consumer a little bit.
Lower oil prices on balance are a benefit to the American economy, but they are terrible for the balance sheets of certain corporations. So as those companies restructure and default on their debt, reduce their dividends.
A perfect example here is, you can't talk company specific, but a perfect example is the Dow merger with DuPont. So you have companies that are benefiting from lower petroleum products because they use petroleum to make chemicals, but they say because of a collapse in commodity sector, a lot of analysts are saying there's no faith in the manufacturing sector right now because of that.
Well, they're saying there were two companies, good companies with bleak bleak futures that can do better by combining, reducing the cost, and then restructuring it to 3 other companies. So it's a value-creating strategy, but it's a result of the end of this super cycle.
So talk to me a little bit about how the contagion now could spread, or how we could contain it, or if the market simply will decide for us.
Well, it's simply time. You've got to work your way through. Every day that oil goes down is the cancer is growing. So the best thing that can happen is that oil and commodities stabilize at these levels, and you work your way through and have the banks restructure and have a long period of workout with slower growth in the U.S. than it would have been, but it still could be 2% next year.
Is it accurate to say that we see once we put out the fire in one house, the next house catches on fire? Because it seems like maybe we got out of the woods on the whole other financial crisis with the banks and the financial institutions, and Greece at the moment is not in the headlines.
Right.
And now we got this issue.
We did it all over again. It was housing the last cycle. The lending market moved from the banks because of Dodd-Frank away from regulated transparent banks into the shadow banking sector, which is less transparent, less regulated. Those people then went out and made a lot of very low-quality loans, which investors were able to would participate in because they needed to search for yield because the Fed kept the rates so low.
The fact is, it's human nature in investors to search out the riskier deals.
We were induced by the Fed. The Fed gave us the cocaine, and we did it all over again. They kept rates so low for so long. People are starved for yield, and they went out and they made all these loans that looked like they could come back to haunt
now,
us.
does a rising interest rate environment squeeze credit more here?
Well, let me tell you, the 25 basis point interest rate environment is nothing. It means nothing to the economy. What you want to watch is the 10-year Treasury. If the 10-year Treasury stays sort of where it is and the yield curve flattens, then we're okay. That's an okay environment. And I think that's the most likely case, quite frankly, because I think growth worldwide is so low that you're not going to get tremendous inflation and a need for 10-year rates to go up. So I think the Fed will do 25 and then be very slow, very careful. I wouldn't be surprised to see this cycle end with the federal funds rate at 1% or less. And a 1% Fed, 220, 230 Treasury, 10-year Treasury, that's okay. You just got to get through these companies restructuring and defaulting.
Jim Awad, fascinating conversation about how the collapse in the oil market now is really hitting home in a real world way. Jim,
Yep.
thank you.
Thank you.
Good seeing you.
Okay.